Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, July 28th, 2025. Hope everyone had a wonderful weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is the Trump administration successfully renegotiating global trade? Our answer, the US and EU agreed to a trade deal imposing 15% tariffs on most EU exports, although like Japan, the two sides appear to be in disagreement on key details. The US EU trade pact levies 15% tariffs on most EU exports, including automobiles, diffusing a potential trade war that could have weighed substantially upon the global economy. Senior U.S. officials confirmed the 15% tariff applies to EU pharmaceutical and semiconductor exports, pending a Section 232 probe due in 3 weeks. The 15% tariff on pharmaceuticals and semiconductors was contingent on the EU's promise to boost U.S. investment. Specifically, the EU agreed to purchase $750 billion in U.S. energy products and invest $600 billion in the U.S., $50 billion more than the investment pledge agreed to by Japan last week. The EU and Japan trade deals represent clear evidence of the Trump administration successfully using the threat of Section 232 tariffs as negotiating leverage to secure better terms on the bilateral front. Per our April 10th leadoff morning note, yesterday the S&P 500 and NASDAQ 100 melted up 9.5% and 12% respectively, their best day since October 2008, after President Trump postponed the greater than 10% portion of reciprocal tariffs by 90 days. Part of the reason markets rallied so hard yesterday was that this was the first time anyone thought the art of the deal could actually work to realign global trade with relatively minimal disruption, ourselves included. Elsewhere, U.S. and Chinese officials are meeting in Stockholm for their third round of trade talks in 3 months, led by Chinese Vice Premier Liu Feng and U.S. Treasury Secretary Scott Bessent. Talks in Stockholm will cover the future of the U.S.-China trade tariff truce, fentanyl linked to U.S. tariffs, and Chinese imports of sanctioned Russian and Iranian oil. The wide scope suggests plenty of room for disappointment. Additionally, recent trade deals with the Japan and EU suggest the U.S. may negotiate harder than it otherwise would have. The latest U.S.-China bilateral trade talks come amid news that China will begin national child care subsidies to counter plunging birth rates threatening its labor force and productivity. This is consistent with our long-held view that Beijing would pivot to fiscal policy to support the Chinese economy because it too is committed to a strategic decoupling of the U.S. and Chinese economies. Lastly, this week's unrelenting barrage of key macro and micro data threatens to justify our crowding model's recent short-term bearish signal for the S&P 500. As always, Team 42 can trust us to effectively extract signals from all the noise. So on Monday, we have obviously the U.S. and China third round of trade talks. Tuesday's highlight includes the June JOLTS report. Wednesday's highlights include Q2 GDP from the U.S., the Q3 quarterly refunding announcement, and the FOMC decision. We also have Meta and Microsoft earnings, as well as Q2 GDP from the Eurozone and the Bank of Canada's rate decision. On Thursday, we have the PCE report from the U.S., the Q2 the employment cost index from the U.S., jobless claims, Amazon and Apple earnings from the U.S. as well. And then we also have the Bank of Japan rate decision, China's official July PMIs, the Eurozone's June unemployment, Germany's July CPI, Canada's Q2 GDP. And then finally on Friday, we have the U.S. July jobs report, the July ISM manufacturing PMI, Japan's June jobs report, the Eurozone's July CPI, and global manufacturing PMI. So clearly a lot for markets and market participants to digest this week. And so as always, we can trust that Kiss and Dr. Mo will keep our clients on the right side of market risk throughout. Transitioning to our 42 macro dashboard, as always, to wrap up the question from our community. This one's titled The Equity Market and the 10-Year Treasury Yield. It says, hi, Darius. Thanks for your analysis in this week's Around the Horn publication. I'm learning a great deal from your in-depth and thoughtful analysis, and in particular, the market and societal implications of the foreturning. You indicated that due to the U.S.'s acute fiscal problem, U.S. and global equity markets tend to malfunction if the 10-year Treasury yield reaches 4.75 to 5%. Also, you are of the view that the Fed should lower the Fed funds rate given the slowing growth in private sector labor incomes and to help the Treasury fund the fiscal deficit by issuing bills at lower interest rates. The lowering of the Fed funds rate will likely not necessarily cause the 10-year Treasury yield to rise, as the Treasury will shift the issuance of Treasury securities to bills and will limit and possibly eliminate in the near term the issuance of notes and bonds. This will negate the supply-demand imbalance in the Treasury bond market, at least for the short term. However, I have a concern that when the Fed lowers and the Fed funds, when the Fed lowers the Fed funds rate, the market may price in rising inflation expectations given paradigm C and a booming economy, and the 10-year yield will rise despite the lack of issuance at the long end. If this plays out, Kiss and Dr. Mo Kiss and Dr. Mo identify the rising downside risk of the U.S. equity market as the 10-year Treasury yield starts to rise? And as an aside, anyone reading this post may find the views of Jim Carson informative as expressed in his recent interview on the Top Traders Unplugged podcast. This whole interview is worth listening to, but the most relevant part of this discussion is from minute 52 to 56. He agrees that the only way out of the U.S.'s fiscal situation is for the Fed to eventually monetize the debt. So, great question. Obviously, a long question, a lot to unpack. First, just want to say thank you to the client for the kind compliments regarding our research. We're glad, it's a blessing that we can, help educate so many people across all walks of life, all walks of all across the spectrum of sophistication as relates to investors, from mom and pop Main Street retail investors to some of the best, most widely recognized and respected PMs and CIOs all across global Wall Street, all receiving the exact same research at the exact same time from 42 Macro, which is one of the few firms on earth that does that at price points that retail investors can afford. So getting back into the question, we talked about this on Friday, and I think it's worth reiterating because clearly we have another question about this. But the general expectation, as an investor, should be that when the Fed lowers the interest rate, policy rate, bond yields also are likely to decline. We talked about this ad nauseum on Fridays, I think on Thursday and Friday last week. So if you missed those, macro minutes, definitely go back and review those. I don't want to, rehash what we talked about then, but the key takeaway is that the assumption that Fed lowering the policy rate all of a sudden is now, bullish for the bond yield, bearish for bond prices is in my opinion, you're anchoring on the recency bias of last fall. That's not traditionally what happens. Traditionally, what happened is that there's a roll as interest rates fall down the curve, a roll down the curve, and there tends to be some decline. Now, clearly, if the market thought that any rate cuts were being sort of pushed through for political reasons, which is highly unlikely given Chairman Powell's resistance to political pressure, if the market thought these were politicized rate cuts, then very clearly we could see some widening of term premia and increase in inflation expectations on the long game of the Treasury curve. That's not a guarantee, but it's highly likely to occur if the market deemed they were politicized. As we talked about last week and reiterating again now, the fact that we saw a sharp deceleration of private sector labor income in the most recent jobs report to 1.4%, a well below trend level of 1.4%, which is the lowest rate, 3-month annualized rate of growth since since June of 2020. And then I think we slowed like 300 or 400 basis points sequentially. That was the sharpest deceleration we've seen since May of 2022. I mean, there's a very clearly, in our opinion, reasons for the Fed to, accept, some, easing at the low end of the policy rate. And quite frankly, the only reason they have not is because they're concerned about how tariffs, which their previous research has always indicated was a one-off price level adjustment, is likely to impact inflation via the expectations channel. Because, by the way, Chair Powell and his colleagues at the Fed were the reason that the inflation genie got let out of the bottle previously. So they're kind of scared of their own shadow in terms of changing their views in terms of how tariffs are likely to impact inflation over the long term. And in my opinion, I think that's a policy make on top of a policy make in our view. So getting back into the actual ultimate question is, if this plays out, will Kiss and Dr. Mo identify the rising downside risks of the equity market as the 10-year yield starts to rise? So again, if the 10-year yield starts to rise just on any rate cuts at the same time, we're obviously mired in a U-shaped economy, that is not a good setup for the markets. You're talking about growth slowing with bond yields rising. That's a terrible setup for the market. So obviously that increases the probability that we saw a correction in the market, and we define correction as a decline of 10% or more in the S&P 500. That increased probability of correction, if the probability was actually rising to a greater than 50% chance, then it's likely that you would see the risk management overlays that we feature in Kiss and Dr. Mo start to tell you to take down market risk, because ultimately the risk is that a 10% correction in that scenario, which I'm not saying is the highest probability scenario, in that particular scenario, a 10% correction could easily morph into something worse, just given, just given the fact that, the market, there's clearly some valuation concerns in the markets. Now, again, our highest probability path forward is that markets generally remain in risk on condition. The market regime generally remains in a risk on condition because there's still a cohort of investors that have yet to, fully recognize and ultimately position for paradigm C, which itself may persist for multiple years, if not 3 or 4 years, in the context of what could potentially happen next fall in the midterm elections. So, in our view, this paradigm C trade has legs. Perhaps we'll see a multi-week or multi-month period of volatility this summer or this fall, associated with the U-shaped economy and potentially higher bond yields. But again, that's not our highest probability outcome. Our highest probability outcome is to stick with paradigm C, and Chris and Dr. Mo have had you guys well positioned for paradigm C since it started buying Bitcoin back on April 14th, and it started buying the S&P 500 back on April 30th. And obviously, it's been largely fully invested since early May, as a function of, again, those same exact risk management overlays, which, by the way, were the exact same risk management overlays that had you raising cash in late February and early March so that you could have some cash to buy the dip with in those buys that we saw starting in mid-April, late April, and then ultimately early May. So you can trust KISS, you can trust Dr. Mo. You don't have to, lie awake, lie in bed all night with your eyes staring at the ceiling, worrying about 4.75 or 5% on the 10-year. You don't have to worry about tariffs. You don't have to worry about any of this stuff. All you need to do is wake up, yawn, and dispassionately execute our KISS and Dr. Mo signals. Period. That's it. You don't have to do anything else. You literally don't have to do anything else. You know what I do in my portfolio? I dispassionately execute our KISS and Dr. Mo signals. Everything else I do is designed to help our clients build confidence in executing our KISS and Dr. Mo signals. I don't need to build the confidence executing the KISS and Dr. Mo signals. I built them and I know how well they work. I've been using them since January of 2023 to make way more money than most hedge funds. And our clients have been using them since January of 2023 to make way more money than most hedge funds. We can see the hedge fund returns. And so the point I'm making here is that you don't need to live in fear of all these different scenarios and tail risks. All you need to do is dispassionately execute the signals. And if the signals tell you to start taking down risk, then you know that the area, the integrand under the left side of the distribution called left tail risk is rising in quantity and rising in and broadening out in scope. And then ultimately there might be some left tail risk that needs to be priced in that ultimately KISS and Dr. Mo will help you risk manage very effectively, in our opinion. So we'll wrap it up there. Darius Dell here, presenting our macro minute for Monday, July 28th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.